It's now time to move on to our next, that is the second workshop of the day, with the theme, Options Trading in Gold. And for that, to chair and moderate the session, may I request Mr. David Gornell, Advisor, LBMA, to kindly join us here on the dais. And joining him in the discussion, we would request Mr. Ravi Ramakrishnan, JP Morgan, Mr. Shivanshu Mehta from MCX, and Mr. Samir Patil from BSC.
Thanks very much for that introduction. I think the last time I spoke here was last year, and I got a very nice thank you from the organizers saying we liked your style and the way that you allowed the speakers to flow. And I think that was another way of saying thanks for not talking too much. So as we're a little bit late, I'm just going to frame what we're doing today. So clearly this is about options, but it strikes me that you've got a good opportunity today to discover the difference between exchange-traded options and OTC-traded options. So from the OTC perspective, you're going to hear from Ravi of JP Morgan, and the other two exchanges will tell you about the traded entity. I would say that they both have advantages. The OTC side is going to give you a more bespoke product, which you can only trade out of with that entity. The exchange will give you the listed option, but you have the advantage of trading that throughout the market with any of the exchange members. So I think what we're going to do is have the three presentations. I'm going to finish up with a book runner's perspective and maybe give lots of secrets away, as I'm now self-employed, no longer working for a bank. And we'll take some questions from the floor as usual, and then we'll finish with a wrap-up conclusion, which I will do. So the first person I'm going to ask to come up to the rostrum is MCX. So Shiv, if you wouldn't mind.
Members of this August House that has the presence of, I presume, the entire bullion fraternity from India and across the world, the most prominent people, my eminent co-panelists, David. So as we stand here, you know, we're talking in the context of MCX having been the hedging platform of choice for the bullion fraternity for more than a decade now, since 2003. That has been via our bullion future contracts. And we stand at the cusp of change, you know, at a point of inflection, as in options are shortly to be introduced in gold to begin with, and other commodities soon. So that is our attempt to complete the portfolio for hedgers and serve them even better. So we'll just quickly run through what options really can do for the bullion fraternity, what our contract is, and a few other nuances. We have average daily volumes in gold of around 15 metric tons for the FY17, and an average open interest of 12 metric tons, and silver 783 metric tons and 500 odd metric tons, with a unique client participation of over 2 lakhs in number. But the most important thing there to note is that our gold future contracts, they have the highest number of traded members, large cross-section of hedgers, significant OI to volume ratio, and more importantly, being physically settled contracts with deliveries in place. It provides for a three-legged scenario for the hedgers, that is deliveries, futures, as well as options. So over the decade, we have tried to contribute by way of being a benchmark price for the industry, and we understand most transactions today take place plus or minus the MCX prices. So from the importer to the bullion trader, the jewelers and the exporters are all able to utilize the platform with correlations with international prices as well as Indian spot markets into the late 90s, 98 odd percent. This, of course, gets augmented by the fact that India itself is geographically so located that we get to see during the trading day movements from TOCOM to Shanghai to Europe, the Middle East, and US as well. Just a snapshot of the deliveries that have taken place on MCX since inception: about 100 metric tons of gold and over 2,700 metric tons of silver. Deliveries, why I put here, is basically a measure of acceptance of price, again, by the industry. It's a measure of correlations of movement. It's a measure of safety from basis risk as well. Now, coming specifically to options, what really they bring to the table is an insurance against adverse movement and yet space for participation on the favorable side. So the maximum loss gets limited to the extent of premium paid, and being exchange traded, there is a freedom from counterparty risk, and there are gazillion combinations of futures and options strategies, so wherein you have the leverage of futures and the safety of options. So put very simply, you pay premium, you acquire a right to buy or a right to sell, and you collect premium, you acquire an obligation to buy or sell. So very recently, the SEBI had come up with norms, and the application was sent, and now we are close to launch. A look at what option pricing is all about. How do you price an option? For example, you must have seen the past 2 days have seen humongous movement in the stock markets. The volatility has risen from a 10% odd level to about 14 to 15% across markets. This is the VIX, the India VIX. If you look at the S&P also. So volatility has been rising. So whenever there is a rise in volatility, it always brings about a change in price. And you've seen the way markets have moved today. So there are two things to an option price: the intrinsic value, which is just the difference between the current future price and the strike price, and a time value, which depends on time remaining to expiry, the moneyness of the option, how far the future prices are from the strike, that is, and the volatility of the underlying. So in a sense, if there's a longer time to expiry, the future prices are closer to the strike, and there's higher volatility, then there would be a higher option value. So it comes to the moot point that when should a hedger use, let's say, X tool over Y tool for hedging? When should he consider using options for hedging rather than futures, and vice versa? So when I said that we'll complete the portfolio, I meant that you have an inventory in place, which is something of a sort of an asset. To monetize that kind of an inventory, you can use options. You see the orange line in this graph, it is nothing but the volatility which I was talking about, the implied volatility. And you see when it peaks, you see the green line, that is the prices. You see a movement in the prices. And they say 9 out of 10, whenever the implied volatility rises, usually the underlying prices fall. So which means what? Which means that those are the very times when the market is willing to give you a higher premium because the risk reward says so. So those are the times probably where one should hedge by writing options and collecting the premium rather than with plain vanilla futures. At times when the reverse is true, when the volatility is low, the market is not going to give you that kind of premium. So those are the times you can probably hedge with futures or buy options, because you'll get them at a smaller premium. So what is volatility? It is basically the most important factor. If you talk functionality-wise, it is nothing but it is a standard deviation of daily returns expressed in an annualized fashion. It measures the degree of uncertainty, and higher volatility generally causes option premiums to increase, and vice versa. So these are the Greeks, which I will not delve too much into, but delta measures the rate of change of an option price vis-a-vis the rate of change of the underlying future. Gamma measures the change in delta itself. If delta is velocity, gamma is the acceleration. Vega is the volatility and theta is the time value. So there are calculators like this, the Black-Scholes model, wherein you feed in certain parameters about the risk-free return, and you are able to generate how much of a change in each parameter would take place if the prices change, if the time goes by 1 day, if the volatility changes, and so on. So coming to what really are a few practicable ideas where options fit into your hedge book, the most important is the producer hedging, which we often hear, the miners and people who have gold as an asset who do this, especially in currencies which are normally in contango, so that creates even higher premium. What it means is you create a floor and you create a ceiling. Suppose you have inventory of X tons of gold and the market is giving you a good implied volatility. You can always sell a call higher than the current price, gather the premium, and buy put protection just under the price. Buy that very money which you've earned, the very premium that you've earned. So in a way, you have actually monetized your inventory, is what I was talking about. And this is called a costless collar. There is nothing speculative about it because you're actually writing it against the physical stock that you hold or a proportion of the future mining that you are sitting on or future production that you're sitting on. So you're able to eat the premium on one side and use that very premium to buy insurance for yourself. So thereby it becomes a costless collar. When we say options can offer you flexibility, to put it in a very simple example, suppose there is a Diwali season and a jeweler wants to offer a flexibility of pricing to the walk-in customers. So he can say, and there are some jewelers who are doing this, that fine, you buy the gold today, I price it for you today or on Diwali, whichever is in your favor. So if the price is, so the jeweler buys a put, insurance by buying a put, if it falls, he earns that much money and he's able to successfully offer the flexibility to his customer. So on. So if there is an unfixed gold, so either your risk is from rising gold prices or your risk is from falling gold prices. So this is an example of a bullion dealer protecting his inventory against falling gold prices. So he buys a put option at a strike of 30,000, let's say 1% premium at the money. So he buys it for 300 rupees. So you can see that from 30,000, the payoff table, 300 rupees, and your loss gets limited, but you're able to profit if the movement is in your favor. One is the physical leg, one is the payoff from the options, and one is the net profit loss. So you can see the loss gets limited to 300 rupees. That is the insurance which you've bought. And on the other side, beyond two strikes, you start actually making money. This is again the first slide, what I talked about. On one side you buy protection, on the other side you remain profitable. This is the other example of buying unfixed gold. Your risk is of rising prices, so you buy a call, and the very same phenomenon. So these are just some of the basic ideas. Of course, the leading banks of the world, the leading brokers would design and customize various strategies, which may or may not talk about speculative aspects, but these are pure hedging strategies, which is why I'm talking about them. Just to review the backdrop, you see when the CTT got introduced, and why I talk about this is because options, the CTT is only on the premium. So India is having this big hangover of bullion contracts where there used to be an with profit exit at one tick, and at that time our impact cost was even more competitive than international platforms. But then came in the CTT and the cost of those exits became 6 ticks and maybe even higher for silver. But it's interesting to note that in the case of options, this is the only transaction cost. So we are getting a lot of interest from the jobbing community, the jobbers who used to be making our contracts very liquid earlier, that they want to set up desks again purely for gold options. The only challenge which we are in touch with the government, the respective authorities, is that the taxation upon exercise, the 12.5 paise on the buyer is a huge amount for comparison with the physical bullion margins that you have, maybe less than 1,000 rupees. But this comes to much higher, close to 4,000 rupees. So we are, hopefully we are expecting that there would be some thought on this before the launch itself, because we've designed a product which devolves back into futures. So it's an options on futures, leaving room for the person to give or take delivery and make that decision over 2 days before we enter the tender period. So we'll not go into too much detail, but the product, like I said, option on our benchmark gold contract, option on gold futures, with that's 1 kilo, with the trading, with a tick size of 50 paise. And these would devolve into futures on the third last business day from the first tender day. So for example, if you're talking about the December contract, and the first tender day is the 1st of December, so it would mean, I presume, the 28th of November. It would devolve back into futures. We may or may not impose a pre-tender period margin. It may be a sensitization report, or it may even be a pre-tender margin. And the premium, the buyer only pays the premium, and the seller, there is a SOMC, which is the margin on his positions, to the tune of 3.5, having taken into account the 2-day volatility, MOPR. So like I said, the long call position shall devolve into the futures and become a long position in the futures. Long puts would become sell positions, short sell positions, and so on. Just to give you a thought, about the product. And all in the money options would compulsory exercise. But here there is a new feature which is being added, which is that the close to the money strikes, 2 strikes above on either side, put or call, they would not be automatically exercised. There would be a window to indicate choice of exercise. And accordingly, if a person does not choose to exercise them, considering that they are too close to the money, so they will not be exercised automatically. So just some of the features we leave you with, and maybe expect a lot of participation from all of you from day one, since you've already given tremendous patronage to our future contracts over the past decade and more. We heartily look forward to your participation in options. Thank you so much.
Thank you very much, Shiv. I think the takeaway for that was monetizing your inventory, I think, is quite an important line. So without much ado, I'm going to ask Ravi from JP Morgan to come up and give the perspective from the OTC side, or at least I think that's what he's going to do.
Thank you, David, and thank you, Shivinshu. I think that was a great introduction to what is in store in the future, especially for MCX and for participants here. I think what I'll do, I don't have a formal presentation, but what I will do is I'll try and elaborate what we do as a bank for, say, counterparties or customers like yourself in the international markets. And I give a flavor of what we help to facilitate and why our clients use options. Because most of the clients that we see who trade with us, say on a physical perspective, they're also starting to use options more and more because they like the flexibility that it offers. They also like the fact that it provides a more customized solution to meet their needs. So we as a bank, as you must be knowing, face a whole range of counterparties, whether it be a central bank, whether it be a physical buyer of bullion, whether it be a physical seller of bullion, for example, a miner. And all these counterparties that we face have different requirements in terms of how their gold position is, how their existing reserves, for example, if you take a central bank, they have certain amount of reserves in their kitty, and what they want to do with those reserves, whether they want to accumulate more, whether they want to buy protection of their reserves. And if you look at a customer, a purchaser of bullion, then they want to take some insurance from prices going higher, say over a period of time. Say, for example, if you have a Diwali season arriving, you know that the local market is actually going to bid prices up because of the demand. Then can you hedge yourself against those rise in prices? And we have miners who, on the other hand, have to hedge themselves consistently to prevent their profits from falling. So I think the exchange offers a great platform to do this. And we ourselves participate in exchanges outside of India. Say the most liquid exchange where we trade ourselves is the COMEX or the CME in the US. And we also provide liquidity to the exchange, and we also take liquidity from the exchange. So we and exchanges like what Shivenju mentioned are great partners, and we work together to make sure that the entire options market is liquid, is tradable, and is providing solutions to your needs. So what I'll try to go through over the next few minutes is try and give some scenarios and some situations that we have come across as JP Morgan with our counterparties, which you may appreciate and which you may lead to some kind of ideas. So one specific situation that I want to take up is, say, for example, a central bank who has a large gold reserve, say 5 to 10% of their reserves in gold. Now, and they enter into this period of time when they think that interest rates are going to rise in the US, it's going to put pressure on gold price. What they try to do is then they have to protect themselves and protect the value of their reserves from falling as the dollar appreciates and their gold prices fall. So what they do is, like Shivanshu mentioned, they would buy some kind of put options to protect themselves from losing a lot of their reserves. Now, what we offer them in terms of as a counterpart who is sitting on the other side is they have their reserves, existing reserves in say vaults around the world. We offer to sell them options on some of these reserves that they have with ourselves or with any other counterparty, say in a London vault, say in the Bank of England vault, or any other vault in any other location. So we customize the pricing for specific dates that they want, for specific price levels that they want of protection, and for specific tenor as well. Say they want this particular protection to last for the next 6 months, or they want protection only for the next 1 week. So we can customize the options for their specific interest of, say, price level, for the specific interest of tenor, and specific even location where they want us to provide these particular gold delivery. Now, the other flip side to that is if you are actually a bank who is actually looking to accumulate more reserves in the bullion market as and when price falls, then what you actually can do is you can actually sell us a put option. And what eventually that means is when, say, if you sell us a put option, say at $1,000 per ounce in gold, today is trading at something like $1,280. So if you sell us an option at $1,000, if you're happy to buy gold at $1,000, then you might as well monetize that option, and we would pay you a premium on day one for it. So if gold prices fall tomorrow to $1,000, you're anyway going to be a buyer of gold. So why not exercise that and collect some more premium? So as you see, a same type of client, a central bank, depending on what they want to do and depending on their view on gold prices, can use similar option structures to either protect themselves or to earn more yield. And this is something that we see a lot of central banks doing actively, doing systematically, and more in a programmed fashion. So I know that options are being looked at quite negatively at times as more speculative tools, as something which is more used for lack of a better word, punting purposes. But at the end of the day, if you use them wisely, if you use them as and when your business requirements or business needs demand it, then I think they have a very powerful impact and tool on your, on your position, on your management, on your risk management, etc. I would like to highlight another example that we came across last year, especially. Last year was one of the years in recent times when gold prices saw quite a bit of volatility. We had so many global events like Brexit, the US election, etc., which caused a lot of volatility amongst in gold price. So what we found counterparties doing is they would hedge themselves, and when I say hedge, what are the underlying situations, or what are the underlying positions against which they are hedging themselves is something that is important to look at. Say, for example, a Brexit-like situation when everybody knew that if this happened, then you're going to see a steep correction in prices of your stock portfolio, of your bond portfolio, of your currencies. And they had a very high confidence and a very high conviction on one thing that would happen if the Brexit vote panned out, that the UK would leave the EU, which was higher gold prices. So leading to several months into the actual voting date, what most of these counterparties did was they would actually buy call options on gold. Now, they knew the exact date of the election. They knew the exact date and the time at which the vote was going to come out. And they had a rough sense of where gold prices or how much gold prices would rally if this happened. So, for example, what you could do is you could either go to the exchange and buy the nearest contract, or you could actually come to a bank like ourselves and buy for a specific date. In this case, say, the July 7th or the 8th of July, when the actual vote would come out, when you would see the maximum volatility in gold prices. So this is something that we could cater to their needs and cater to their requirements and offer to them as a specific product. So a takeaway for most of you from those kind of situations is, say, you could buy, say, call options on gold if you think on dates around Akshaya Tritiya, for example, or dates around Diwali, when you think that the demand for gold prices in India is going to surge and the prices for gold would actually increase in the local exchanges. So something like this is very popular. Who would we see in the international market doing this? Is any investor who has a large stock portfolio which would be at risk from falling stock prices or falling bond prices. We would see a lot of hedge funds who would do this because they, I mean, by nature of their trading style, they would want to bet on some of these events panning out and hurting some of their underlying portfolios. So they would want to use some of these gold structures as you know, a hedge against some of these events. So again, this is something which I think, if taken into the Indian situation, I think can be used very smartly and can actually protect yourself from your sales, from any volatility in your sales that you would see if prices rise too much, or if you know, you can actually monetize your own sales by, if in case you think that a sharp fall in gold price in the international market is going to actually bolster your sales. The last example that I would like to give is something where we customize products using the exchange traded options is for some of our miners and producers across the globe. If you're actually running a mine, say in Australia or South Africa or whichever part of the world, then you would actually be producing gold every month, every day from the ground. So what we see some of these miners or some of these producers doing is they actually have gold coming out every day. So they have a certain ounce or certain tons of gold being produced every day. So they don't want to take exposure to gold on a specific date, for example. They don't want to trade gold on a specific date at which the exchange option actually expires. So they want to trade gold on every day. So what we provide to them is something like an averaging feature where we say that if you're producing, say, 100 ounces of gold every day from your mine, then we would give you a contract which actually is settling against 100 ounces of day against the gold price on every day. We would use something like the gold PM fixing in London to settle against your option, and we would actually be able to give you a protection against gold prices falling lower based on the average price of the month. Because you're consistently producing gold every day, you actually don't want to use one day's price to sell your gold. You actually want to average your gold price over the entire period of your production cycle. So that is something that we're able to customize And that is something that we are able to provide to our customers, a sort of averaging feature. And what we would ourselves do is we would actually be using some of the exchange liquidity to hedge some of our risks. Now, there's obviously going to be a kind of difference between what we are offering our customers and what we are actually able to get from an exchange. So this is some risk that we always run on a daily basis, and this is something that we are attuned to do over a period of time as a market maker or a risk management provider. So given that we see a lot more of these flows which are more bespoke in nature, there is also a basis for us to add value to customers such as yourself who have different requirements. So again, if you are, say, a customer of bullion who is sourcing bullion from outside India, and you're getting regular shipments every week and every fortnight, then you would want to have some feature like this, whereby you're able to hedge your price risk on gold on actually a more regular basis than actually a monthly or a bi-monthly basis, which you would be able to do on the exchange. So these are some of the ways I think that you can actually take the exchange contract and tweak and actually trade in a slightly more customized manner to meet your business volatility and business needs, and thereby achieve the solution that you want, which is essentially to protect your profits using some kind of options structures or option strategies. I think those are some of the learnings that I thought we could bring from the kind of international markets to the Indian market. We can use the MCX provided option liquidity to customize structures and propositions for yourself based on the business needs that you would have. So I think any further questions on structures or customized solutions that you would like to have, happy to discuss. But these are all structures that you should be thinking of as and when the options contract come into place, and as and when you get more of these strategies to be able to put into your own business. Thank you. Thanks for that.
Thank you, Ravi. Okay, our last speaker today is Samir from the BSE. So this is the second of our exchange offering. Interesting to hear that I was trying to explain how the OTC world coexists with the exchange world. As Ravi just explained, that they can create bespoke solutions by using the exchange contracts to create the client OTC side. Another important takeaway there was using options for key date risk, such as Brexit. So I'm going to ask Samir to give the last presentation before I say my words.
Thank you, David. Fellow panelists, friends, colleagues, ladies and gentlemen. 9th of Jan 2017, a most historic day in the history of the financial markets in India. The launch of the India INX, the wholly owned subsidiary of BSE in the GIFT city. GIFT is Gujarat International Financial Tech City. Launched by the Honorable Prime Minister of India, and being the free trade zone in India, the first free trade zone in India, and BSE is proud to launch its first international exchange in India, that is the India INX, and along with it, its clearing corporation, the India International Clearing Corporation. And the launch was on the 9th of January, and trading started on 16th of January 2017 and inaugurated by none other than the Honorable Finance Minister of State, Shri Arjun Ram Meghwal. I remember what Shivanshu said earlier in his presentation, that over a decade, how the Indian markets have evolved, and how the commodities markets, and especially the gold markets, and how the futures markets have evolved. I've spent more than a decade with the MCX earlier, and how the introduction of commodities transaction tax in India has impacted the futures trading, and also the impact cost of the futures. So, keeping this in mind and keeping this as a base, I would like to inform you all that today on the India INX, we have launched the gold contract, that is the 32-ounce contract, expiring, it's a bi-monthly contract expiring on the international prices, and it is a zone where there are no taxes whatsoever. There is no income tax, there is no stamp duty, there is no CTT, the financial transaction taxes, nothing whatsoever. So today we see a good traction in those volumes, and we trade around 40 to 50 millions of around 40 to 50 millions a day. And very recently, that is today, we have launched the new contract, that is the kilobar contract, and these are all dollar denominated contracts minus all taxes. And today we are launching a kilobar contract, which is a kg contract traded in dollar, traded in dollars and settled in dollars. And this is a very unique contract because the first time in India, this contract has been launched in an international venture and would be settled on the IBJA prices, that is the India Bullion Jewelers Association price at the end of the expiry. It is again a bi-monthly contract. So all reputed traders, bullion dealers, end users, hedgers, who all are part of the August gathering here, can always look forward for these platforms, to this exchange, to come participate and mitigate and hedge themselves on this platform, because it is very simple. All Indian entities who are SEBI-registered can form their wholly owned subsidiary and be a member of the India INX and participate on the exchange, minus all taxes. So this is a very, very good liquid platform for all end users to come forward and participate on the exchange. And we have again applied for the options as well. So we are awaiting approvals from the regulator. As and when we get the approvals, we would be very soon launching the option contracts also on the India INX. So this is a very, very robust and solid ecosystem, trading ecosystem and trading venue, where you can, the end users, the hedgers, the active traders, participants come forward and hedge themselves on the India INX. Now it takes me back to the down the memory lane, because graduated from the B school, just joining, I was with the Cargill Investor Services. I remember around 10th of October 1998, if I'm not mistaken, on Friday, gold was trading at around $288 per troy ounce, and never witnessed so much of volatility in gold then, and it was just the beginning. We used to see around $2, $1.50, $3 movement in gold. So it was Friday evening, markets were supposed to close, and all of a sudden we came to know there's a strike in the Ashanti gold mine, and all of a sudden on Monday, Tuesday, Wednesday, we saw some tremendous movements, and gold made a high of $339 per troy ounce on Wednesday, and the same day, not same day, but the same hour, it came back to again 318. It made a low of 327 the next moment, and $318. And you can go, might as well go and check the charts. It was very, very volatile that day. I remember my first trade in options then. Gold was trading around $300 per troy ounce, and somebody on my floor said, "Why don't you buy options?" And until then, I was only futures. Only futures struck to me. And then said, "What is it?" Opened the screen, showed me the premium values, and said, "This is what." I said, "That's it." "Yes, that's it. You book, you buy a call. You can either buy a call, you can sell a call, so on and so forth." So I bought a call at 300, and I paid around $13 premium per lot, and gold made a high of around $339 per troy ounce and came back again to 327. By the time I could liquidate, my dollar premium increased from $13 per lot to around 27, and eventually got out at 23. So I made a profit of $10 per lot. And this was my first trade on options, and hence I can remember it each and every tick, because the first trade you cannot forget in life. And this is how I came across the options on gold on the CME, and this is how I got used to these options. Then slowly and steadily, when I got more into it, I thought this was one of the most sophisticated product. Rather, besides the futures, along with the futures, you can have so many sophisticated strategies built up, traded along with the options as well. You can buy a call option, you can sell a call option, you can buy a put option, you can sell a put option, you can build so many number of strategies. So all the physical traders, the hedgers sitting in this room, when they take a short position, suppose you imported gold, you hedge yourself by selling a futures contract. So you have X amount of margins almost imposed on your futures position. There is a directional move on the market. Now what next? If the market comes down, definitely you're making a profit on your futures market. If it goes up, you're making a profit on your spot market, on the spot price. What next? So when you have so many strikes and on options, the most important thing here is to keep in mind is the time interval and the strike prices and the intrinsic value. The nearer to the existing price, the more value it might gain or take away from you, and the larger the premiums you need to pay. The moment the price moves ahead of you and you have taken or sold an option which is far off from the existing price, the lesser the premium you pay, but nevertheless there is an time value also determined, the decay value, which is known as. So it has an expiry. Every 2 months the option will expire, and eventually you come to know, okay, I had bought this option, now after 2 months the market hasn't moved at all, so I lose out on my premium. So what is my risk? The premiums that I paid only. What you can do, you can buy an option, you can sell an option. When you sell an option, yes, you have to pay a margin along with the premiums. So you are basically taking a sell position in the futures as well. This contracts again expires on the futures. That means if you have an open position and 2 or 3 days before, it gets converted in the futures position, and then your liability is again shifts from the options to the futures, and then your position gets converted from an option to a future. So these are the various important things that you need to take into consideration, need to take into mind when you trade options. But nevertheless, these are one of the best derivatives products, and introduction of this in the Indian markets. We have seen a lot of robust activities in the currency futures and the equity options here. India market is the European market, European options market, like the CME and the ICE, and TOCOM is the traditional American markets, American options market. So these are the differentiating options basically. But nevertheless, people in India over the period of years have been used to trading equity options, the currency options, and now the emergence of the options in the gold and on the Indian domestic markets, along with the international markets in India as well, on the India INX. So we see a lot of foreign participation. We are on the India INX. We see a lot of Indian sophisticated traders, hedgers coming forward, participating on the exchange, building very, very sophisticated strategies. Mainly, you must have heard of the butterflies and so on and so forth. So yes, this is definitely a beginning and a new step taken in the derivatives market in India for the commodities market, and we all thank everybody for it. So we look forward for your participation on the India INX as well, and the India options market as well. Thank you so much.
Thanks, Samir. So you now have a kilo dollar gold option, which was news to me. It's okay. Right, I'm going to take some questions at the end. I just wanted to give you my take on this, and from an option market maker's perspective. You're probably asking, well, where does the bank get the options from? And the way that they're created is by writing them, and in a very similar way to insurance is written. And it's a theme I want to pick up on, so that for those of you that haven't come across options before, there is some empathy, and you can compare it to something that is perhaps a little bit more familiar to you all. The things that we look at are very, very similar as an option trader as if you're a bullion merchant. So if you're a bullion merchant, you're going to have gold in stock. You're going to have a just-in-time service. So if my clientele are really based around the mining community, as Ravi was explaining, then I'm going to make sure that I've got some put options to sell them. Otherwise, they're not going to come back to me. And I can create those in a number of ways. But what I'm really looking at is the implied volatility as compared to the historic volatility. So if we look at 1 month forward implied volatility, the first thing we need to compare it to is the previous 1 month. It's not perfect, but it's the closest thing that we get to creating fair value. So if, for example, there's an option at 10 vol that's pricing at $10, and we look at the historic volatility that says the last 30 days was $5 and 5 vol, you can see that the one you're looking at today is very expensive, indicating that there is a buy-side demand for that option. It might not be the best time to do it. The other thing that we would look at is, we've been touching on the difference between exchange and OTC. Now, there's not a lot of data available yet in the OTC market to see what's out there, but there is data available from the exchanges. So what you can do is you can look at the open interest, you can look at a strike price, and you can see how much interest there is on that. I would also say be a little bit careful because it could be the OTC market being long of an option and selling the same and creating this open interest on the futures side. It might not, but it gives you an awareness. For those of you that never really thought too much about options in the past, when I used to market these to customers, most people would say, well, David, we all know that 90% of these options expire worthless, so you're getting me to buy something that's not going to really get me anywhere. And I would normally answer that one by saying, well, when was the last time you had a fire in your building, a fire in your house? And they look at me a bit strange and say, well, you haven't had one then? And the answer is invariably no, of course. So I would then put it to them that they've cancelled all their fire insurance policies. And then they begin to understand that some form of option strategy built into your portfolio is a very relevant thing indeed. I think I might want to say one more thing on the benefits of owning an option, going back to the parallel with insurance. When you own an option, so long as there is life left in that option, that is time left in that option, it has a value. So if you've had a motor insurance policy and you've sold the car and you've torn it up halfway through its life, it has zero residual value. That is not the case, for the most part, when you own an option and you sell it back. So if you want to sell it back to the market maker, he'll give you a price. It might not be much, but they do carry some residual value. And I can see the clock ticking down, and I've got to allow some time for questions. And as I've got one in my hand, and this is to you, Shiv, this is a very good question. How will liquidity be created? Liquidity. How is liquidity created in the option market?
You see, I mean, being a neutral platform, being an exchange, there are actually certain things to look at when you talk about liquidity. This is an option on futures which we are looking at. So there is an already running futures contract which is probably one of the highest volume contracts, which is the gold kilobar, the gold 1 kg contract, on which will be the underlying for this option. So there is an automatic buildup of liquidity in that sense. Now, when you look at the participants, on one side are the writers whom the Indian equity markets have seen over so many years now, and who are also active on our platform. Not in options yet, but because there were no options yet. So they are eagerly waiting on the sidelines. On the buy side, of course, like I said, there is tremendous retail participation in commodity markets, especially in the gold contract. If you look at the number of unique client codes there. There is also a huge and most important segment of hedgers who are already hedging via futures. And over the past 1.5 months, we must have engaged with hundreds of them, and they are looking at using options for various angles. It could be inventory, safeguard, because there are certain jewelers who do evaluation and they want a floor for their inventory before they roll over into the next financial year. There are the flexibility pricing people who are very keen, who are looking at this. So this is the basic backdrop. So liquidity should automatically get created. Liquidity begets liquidity. Having said that, there are certain, policies in place which I will not delve too much into, like the LES, which certain segments today have, the liquidity enhancement schemes. So this being a new segment, I will not talk about it right now, but there are certain things in place which can formally be at some stage.
Thanks for that, and I've got two very quick ones here. Do you have designated market makers? Do you have them in your markets?
As of now, the policy does not permit this.
You don't have any, Samir? Do you have any
India.
designated market makers? Yeah.
No, we do not have any market makers, but can I throw some points on this, on the question of liquidity? Because what happens is, yes, you have the market, the robust market, the underlying futures market. Second, you have the traders, the end users hedging on a long-term basis, on a long duration contract. So here what would happen is, there is a base price, there is a current strike, and you have strikes various ups and downs, okay? What the end users can do is, they have a choice of putting their quotes on their need, their basis on various strikes. So this is how, what can happen is, there are various, and the traders come from various walks of life. Somebody must have imported, somebody might have exported. So some might have different valuations of their underlying value. What they can do is they can always put their own strikes, and at the end of the day, this is how the market is created.
Okay, that's quite an interesting point, because most exchanges, when they start a contract, would have designated market makers to give you liquidity. There's quite an interesting answer there, because there's probably some value in that for you guys. If the market is going to fall to find the price, it's going to keep going if there's no liquidity. And if you're a buyer of that option, you might find good value. I've got another question here about cash or physically settled. The actual question was, is it possible to take delivery? Yeah, either one of you, yeah.
Yeah, definitely deliveries is an important aspect in this contract, in the underlying contract, and which is why the functionality or the limb which gives delivery is attached to this option. How? Because it is an option on futures. The futures are deliverable. It devolves into futures, giving you 2 days after having devolved. You get a futures position after having adjusted your profits and losses. Ultimately, you have a long or a short position if you leave it to exercise. After which you get 2 days, and then you can decide what you want to do, and then you move into the delivery period. So deliverable, yes.
Thank you very much. Right, I think we've run out of time. Are there any questions on the floor? Yeah, can we have a microphone here for this gentleman?
In MCX, now you have got the authorization for gold options, right? So I just want to know from you, what are the expiry months, when the option is to be declared, when it will be physical delivery, 2 days after you are telling, after declaration, and what are the months, future months, after 1 month. It is a European type option, so it can be exercised on a particular date only, right?
Yes.
And in between, if somebody want to sell that option, it will have to be sold through some broker. Can you highlight
Yeah, sure.
that?
So on the functionality aspect of it, yes. Being an option on futures, it devolves back into futures, which is called the exercise. The exercise is on the third last business day prior to the first day of delivery. So we have bi-monthly contracts in gold, right? So February, April, June, August, October, December. So on the third last day of the first day that the delivery starts, let's say 1st of December. So 28th of November, the option would expire and devolve into futures. If you come to October, let's say 27th of September, it would devolve into futures. That is one, that is the functionality. If you're talking, you asked me about the margin as well.
I want to know, when option is declared, then it is converted into a spot contract or a future contract for, so how many days after? 2 days, or it will be, how many days?
Yeah,
when
so
the physical delivery is required.
Yeah, so it gets converted into a futures position on the third last business day before the beginning of the delivery period. Okay. So beginning of the delivery period, let's say for December contract, let's say it is the 1st of December. So the option would expire on 28th of November. Okay. And then you would get 2 days to decide. You'll get a futures position in your hand. You'll get 2 days to decide what you want to do further.
Okay, but delivery or selling?
Okay. Thank
and
you
if
very,
you want
very
to
much.
trade before that, you can always trade in the premium. You can, whatever you have bought, you can sell, and vice versa.
And what is the lot size?
Ooh. It is 1 kg, sir. It is the same as the
minimum.
It is the same as the futures contract. So typically, the premium would be presumably around 1% at the money. So it would be around 300 rupees.
Okay.
So you would see the prices of 300, 301 like that on the street.
Strike prices.
I think it's
and
great to see.
The strikes will be 100 rupees strikes above and below, 15 above and 15 below the at the money. So which means 1500 rupees on either side, around 3000 rupees are covered at any time. And we can open up the strikes as and when the market moves. There is no restriction on that.
Thank you so much, Mr. David, and thank you to all our panelists present here for that very robust session. And of course, it has opened new possibilities in trading options, and I'm sure you must have benefited quite a bit from that. We request Mr. David to now present mementos and felicitate our panelists, starting with Mr. Ravi Ramakrishnan. To Mr. Shivanshu, and and to Mr. Samir Patil. Thank you to each one of you, and thank you to Mr. David. And at this moment, I would request Mr. Rajesh Khosla to join us here on the dais for a special felicitation of Mr. David. Thank you so much.